Hey everyone, welcome. How's it going? I just noticed my ticker tape behind me is not on, but that's okay. Not that important. So today, when we're looking at our markets, the bullish, it did not start out that way. It was very much choppy, and we ended up just a little bit higher, not hugely. So actually, I'm going to take that back. 0.38% is somewhat significant. Hey Fazio, hey Roger, hi Lise, hi Bowtied Naga, great to see you guys. Let's so I was just saying that the market was bullish most of the day. It was chopping sideways, and then it went bullish at the end. So if we look at how that developed, what we see is that chop, 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 and then it was right over here last couple hours where we just went directional and stayed at that 2 sigma level and just rode it all the way up, which is kind of crazy to have that run up at the end. For most of the day, if you looked at my channel over here, the gamma levels, there we go, that we had in the morning, I said, well, this is such a huge range. It's difficult to say anything and really, and it there was a bit of a peak over here at 663, but it's hard. It's spread out so far. It's hard to say that 663 would actually be something significant. And what we could get was maybe a range, but that range was so wide that how helpful is it really? 655 all the way up to 670. We did end up at 666. So was that really helpful as a predictive or as a trading tool? Not really. Same with the SPX. It did range up to 6690, which is kind of close to where we closed. But the important information here was that it really looked like the market was going to be choppy, and that is what we got. And right around 8 or 9 or 8 or 8:30, I was going to send a message to the Telegram channel that days like this, the movement is so predictable. For it's a day trader's dream, right? It's like just buy here, sell here, buy here, sell here, buy over and over again. You get to do it until it finally failed right here and you would have stopped yourself out. But that was one loss versus one, two, three, four, five, six, 7, 8, 9, 10, 11, 10, maybe 10 wins. So it really was a day trader's dream today, but I got distracted. I was sending out alerts for my services, and then I saw Roger sent out something almost identical to what I was going to say. So it's like, forget it. I'm not, I'm not going to put it out. He already did it. It's going to look like I copycatted him. So, but just know, like on days like this, it's just straight sideways. That VWAP is going sideways, and we're just bouncing from 2 sigma to 2 sigma to 2 sigma to 2 sigma, right, over and over again. Just makes it for super easy day trading. It's not so great for directional trading, although at the end it went directional. So that if you were bullish, then you would have been fine, especially bullish swing trading. We don't care about this intraday chop nearly as much. So market, yes, definitely moved up. Yes, we definitely bounced off of that EMA 20 earlier today or earlier last week, so Thursday. And today, what we notice is that we actually bounced off of the EMA 8, and intraday, we actually bounced off of it several times. So if I go back to that chart, the EMA 8, there we go. So we came close right there. We basically touched it right there. We came close again. So that EMA 8 on a short-term basis is holding very strong. So that makes it look very bullish for the markets. There is some concern of a shutdown. I'm not concerned about it. I've seen so many threats of shutdowns my entire career, and there's only been two where they actually shut down. One was quite significant. It was 30 something days. And that in the end, it didn't really affect the market that much. So yeah, while we were shutting down, people were speculating and unknown, volatility is high, we don't know what's going on. But then it was just fine afterwards. And then the same thing happened back in 2018 or 19. There was a shutdown because no one could agree over funding of the building of the border wall, the US-Mexico border wall. And that dragged out for, I think, 19 days. So, and there's the same thing. After the government came back online, then it was nothing. It was a big nothing burger. So even if we get a shutdown, which I highly doubt, but if I'm wrong and we do get a shutdown, then I don't expect it to really affect the markets. And if it does affect the markets, it's only going to be for a few days while we're shut down, maybe for a day or two after they come back online. So I'm not really expecting anything. So the only concern is any trade that you might hold or you might try to exit, your expected hold time was during the life of the shutdown. So if we shut down for one day and you're expecting to exit on the second or the third, then your trade might be affected. But if you're expecting to exit on the 10th or the 17th, your trade probably won't get affected too much. So I'm not making a big deal out of the shutdown. If I'm proven wrong, then it would have to be a dragged out shutdown. And I don't think anyone in the government is prepared to do that. So we're gonna not really focus on that. I'm gonna just operate as if that's not really going to happen. And the way that the market has traded, the market doesn't really care either. Right? So whether it thinks they are or they aren't going to shut down, it doesn't really matter. They don't think that it's going to affect the markets. Otherwise, we wouldn't see this continued bullishness. We'd have a lot of uncertainty, maybe some movement downwards or some just very flat trading, and that's not what we got today. Okay, so now that this is bullish, that's green light. Keep on going. Look for pullback opportunities. Why pullbacks and not breakouts? Because we're not yet in an environment where the market is just screaming higher. So you're better off with the pullback opportunities. Also, net GEX or gamma exposure in the market. Let me pull that up. On the SPY is net positive. So net positive environments, we want to buy dips. And if we were net negative, then we would go for those breakouts. And we don't go net negative all that often. So we're better off most of the time trading pullbacks, and those are higher probability trades. And they're not necessarily as lucrative as the breakouts, as we were talking about yesterday, but they can still be really, really great trades. So we can see right here, the overall gamma is positive, 757 million, which is not super positive. Generally on the SPY, we can see maybe 1 to 2 billion, but it's on its way. Remember, we just got options expiration not too long ago. So 757 is still pretty positive. So I'm looking more for buying dips. And then I should, before I move on to the questions that I was asked to cover, let's take a look at what happened with Albemarle, okay? Because this is exactly what we were talking about yesterday. I said my trade idea is that this could be a breakout and a retest. And I said that intraday, if it bounces, then that would be the entry into Albemarle. And I said, if we enter, then if it broke 83, then I would stop myself out. That's what the orange line is. Well, it gapped down at the open, so we never got the bounce. So it should never have been entered to begin with. But if it was entered for whatever reason, like we jumped the gun and we were anticipatory, not reactive. So and we just entered right at the open, even though it broke down right at the open, it should have, again, the signal was invalidated right there. The trade idea was already invalidated. But assume maybe you put the order in like I did yesterday and you just left it there and you weren't paying attention and it got filled. Well, when it broke that 83, and like I said, it had to close below 83. But once it broke through and very definitively broke, like it was very clear that we weren't going to bounce and close back up above 83, that was the time to stop ourselves out on this trade. Now, remember I said, well, Kane, we're so far from these moving averages. Why aren't you should be trading a pullback? I said, great, that's a different idea. So we trade one idea, and if we want to trade the pullback, it would be a different idea. And we would say, is this the pullback? Well, the answer is no, because it hasn't bounced yet. Okay, so this is not a valid entry for the pullback either, although it could be. If we get a green bar and we say that it bounces off of the EMA 20 and we get a green bar and it closes above this day, today's high, well, that would be quite a recovery. And then that would be a signal that perhaps we bounced. And then that would be a valid bounce or pullback entry. But then you've got to be careful, because then you've got resistance right here again. So then you might still want to just wait for a breakout. But again, different trade ideas, right? So if your trade idea is invalidated, you're out. You're done with this trade. So hopefully no one jumped in and you recognize that at the open it was already below, and the breakout trade was already invalidated. But even so, if you got in, then the stop out was appropriate over here at this 83 level. Okay, so I just want to point that out. And yeah, we get trades wrong. Okay, so our trades are invalidated sometimes, and we recognize that. I said yesterday it was maybe a 60 to 65% chance of breaking out without that confirmation, right? Probably closer to 60. So we looked at this trade without the confirmation in place. So it proved wrong, and it looks more like a pullback, although the pullback isn't guaranteed either. It could just keep on going down. So we'll just have to see. Okay. Hey Kay, hey Illinois grain farmer. I haven't seen you for a little bit, Illinois grain farmer. James and John and Kirk, good to see you guys. Okay, so let's go on to the educational portion. And I was asked a few times, a few different ways about spreads and iron condors. And I covered some of spreads over the last few sessions. So I think I'd rather focus more on iron condors, but iron condors necessitate the discussion of credit spreads and not debit spreads. So normally I talk about debit spreads. I don't do a lot of credit spreads. I almost never do credit spreads. For me, there's almost never any reason for me to be in a credit spread, because I can just make the equivalent debit spread and they behave the exact same way. Right? And for management reasons, for tracking purposes, for understanding my portfolio and positioning, and also for the sake of not having to care about assignment risk, debit spreads are more advantageous. So I always, if I ever want to do a credit spread, I tend to convert it into a debit spread instead. So let's talk about some iron condors, and then we'll talk about credit spreads, I guess, in the discussion of that. So let's find a stock. You guys have a suggestion on a stock you want to look at? Probably have to wait for the delay. Usually get at least one or two suggestions. If not, I can pick one. Okay, so either no one has a suggestion or there's a huge and massive delay. IREN, what's IREN? Is that a ticker symbol? Oh, interesting. I never heard of this stock. Okay, so if I was going to look at this stock, it would clearly be bullish. And then it looks like we got Target and we got CRWV. Okay, yeah, let's look at all of these. So I'll start with one, and then I'll apply the same principle to each of them. AXP, sure, okay. So I'll start with the first one, that was IREN. And first I asked myself, should I be bullish? Should I be bearish? Or should I be neutral? Or should I not even care about this stock at all? Okay. And a lot of that goes into that trade idea that we've been talking about over several sessions. The development of your trade idea, all the different reasons why I should be bullish, bearish, or whatever. For today, I'm not going to take all the time to develop that whole trade idea for these. I'm just going to assume that we already did that part, and I am going to be bullish on this for purely technical reasons. We have a beautiful rainbow right here in our moving averages: red, orange, yellow, green, blue, indigo, violet, whatever. And that means my moving averages 200, 150, 90, 50, 20, and 8. They're all on top of each other, all in order, all sloping up, and with increasing distance between them. Meaning if I look at these two, the distance right now between them is bigger than the distance when it was back here. When I look at the blue and green, the distance between them now is bigger than the difference right here. When I look at green and yellow, same thing. Yellow and orange, same thing. And then orange and red, same thing. The distance is getting greater and greater. So this is a really strong, really beautiful uptrend. I came back, tagged that EMA 8 a couple of days ago and bounced back up, and now it's at even, but I really should expect it that it can continue to go upwards. So if I was going to trade this as a credit spread, well, or any spread, okay, so basically I would want it to point upwards. If I was doing a debit spread, then what I would do is I would sell something underneath it or right at it or above it, depending on how much risk you want to take. Let's just say we want to be a little bit safer and say I would sell something underneath it, maybe at that EMA 8 or right at 43, okay? And then I would buy something below it, so for 42 as protection, just as an example, okay? So this would be if I bought calls. So I'd be selling, I know the colors are maybe backwards because you might think of, oh, green, I'm going to buy it, but I'm using green as this is my max gain zone, red is my max loss zone. So I'm actually selling this 43 call and buying a 42 call if I want to create a debit spread. Okay, so I'm selling something less in the money and buying something more in the money. The thing that is more in the money is always going to be more expensive. It'll be at a higher delta, so it'll always be more expensive. And therefore, I'm going to net pay a debit, and then that would create my debit spread. So let's just visualize it over here. And then I'm not going to bother with expiration dates right now, or we can go over that later. So if I said 43, right? So if I sell the 43 and buy the 42, okay, that creates a debit. 33-cent debit, which is, oh, this one's super wide. 43 is super wide for some reason. So I can't realistically expect that I'll get 33 cents for this. That's crazy, because that would be almost a 200% return on something that's super deep in the money. So that's not realistic. Yeah. You can see that the bid-ask spread is super, super, super wide. But in any case, going back to the principles and not the practicalities of trading it, the 43 and 42, this is how I would build the debit spread. So to create the equivalent credit spread, then I do the same thing. I just, over here, I sell the vertical. I sell the exact same strikes, 43, 42. But what happens is now I'm still selling 43. I'm selling the 43 put, and I'm buying the same strike. I'm still buying the 42. But because now these guys are out of the money, I am selling something that is more in the money and buying something that's more out of the money. It's the exact same. Sorry, it's the opposite. It's the it's the same, but the opposite over here. Okay, so basically, I am I am selling a higher delta. Wait, am I saying that right? I am selling a bigger delta. Yes, I'm selling a bigger delta. Okay, this is negative 30 versus negative 26. So I'm selling the larger delta, and therefore that's the more expensive one. Okay, and since I'm selling the more expensive one, I'm going to collect a credit. So again, if I model these two up, the 43.42 put and the 42.43 call, one's a debit spread, one's a credit spread, I'm going to end up with the exact same thing, assuming that they're priced the same. Okay, there could be skew, or in this case, the bid-ask spread is so wide, who the heck knows where we're actually going to get filled, and it's a lot tighter over here on this call side. So on this call side, that could be one argument in one special case instance where I'm actually more comfortable doing the credit spread versus the debit spread. If there's a huge difference in liquidity, then I'm going to go with the one that is more liquid every single time. But in this case, I would probably just not trade iron because the bid-ask spreads, even on the put side, are quite wide. But that's how we construct. That's the equivalent credit spread. Okay, and they're going to behave the exact same way, meaning that that's still my max gain, that's still my max loss. And assuming I could get the same price for each one, then I would have the exact same break-even point also. And so they're always going to behave the exact same way. And then assuming I'm using the same strikes at the same expiration. So that would be a bullish credit spread. So we call it a bull put spread or bull put credit spread. Let me do the same thing on the other ones that you guys pointed out. So TGT, remove this. So over here, again, I'm not going to develop the whole trade idea. I'm just going to look at things technically. This is a downtrend pullback to the EMA 20. Technically, I would want a confirmation and see it bounce off of that EMA 20 back down. But let's just say, okay, net, we would say that this is bearish. Not looking good, not looking super good for target right here. So if we expected this to go back down, then as a debit spread, you would do something like this. And you would buy puts and sell puts. So this would be a sell put at roughly 90. And then 89, or sorry, yeah, 91. We would buy that one. Okay, so to turn it into a credit spread, then you would sell the exact same strike except as a call, and then buy the exact same strike except as a call. Okay, so let's take a look at that one. And I'm going to let's just assume October 17th. You see, I already have a position in one of my accounts over here. But if we said 90 and 91, right? So if I sell this vertical, did I do that wrong? Sell. Oh, sorry, I need to buy that vertical. I need to buy this vertical to create a debit spread. So that's the 91, 90. Okay. You can see that's for a 59-cent debit, roughly. And then if I do the same thing, if I sell this on the call side, okay, then we see a 37-cent credit. So there's some skew, but we can see that there is a small difference in liquidity here. These are 10 wide, right? And this is a little bit bigger. This is 14, and this one's only 9. Okay, so there is a little bit difference in liquidity. There's a little bit of skew. And so to do it as a credit spread, at least at the mid price, is not as lucrative. Because if I did the other one, the debit spread at 59, then I have 41 cents or $41 of profit potential versus my 59 at risk. And then over here, I have $37 of profit potential versus $63 at risk. So they're slightly different, but if we could get them, if there was no skew, we could get 41 credit for it, which we could, because look how wide this bid-ask spread is. Okay, so if we could get them at the same price, they're going to behave the exact same way. So if we did this as a credit, then that's how it would show up. Now, I'm not going to bother with AXP and CRWV. I think you should have gotten it by now. So, hey, Spider Monkey, good to see you. So, what is an IR Condor then? Well, a IR Condor, so if we did this as a credit spread, an Iron Condor would just simply be doing another credit spread in the opposite direction. So if I do this, let's just say I'm not bullish or bearish on target. Let's just say I think it's just going to chop sideways. And say, hey, look, it came down here, it went up to here. I think it's just going to do this. I think it has to consolidate for a while before it's going to move back down or before it's going to break upwards. So if I believe that, then I have a bearish credit spread pointing down and a bullish credit spread pointing up. And so my max profit zone becomes inside of these green lines, and my max loss zone comes outside of those red lines. Okay, so let's show that on OptionStrat. And I might need a couple of these so you can see a side-by-side comparison. And most spreads are built by piecing together verticals. Unless you have different expirations, then they're basically built by piecing together diagonals. Okay, so just so you know, so if you ever say, oh, what's a butterfly, what's a whatever spread, jade lizard, whatever the heck they call them, it's always take a vertical and stack on another vertical, or maybe two verticals, or take a vertical or a diagonal and stack on another diagonal. So you can always understand them by piecing together the individual verticals or diagonals. So we're going to do the credit spreads, we're going to do a bull put, and then we're going to do a bear call. And we're going to do it on target. And October 17th. And let's just do one at a time. So we'll ignore one side, that side for now. And we said on target, this is the bull put spread. So we said about, let's say 86. Just make life easy. 86, 85, okay? So we are selling the 86, buying the 85. And what that creates is a credit spread that looks like that, like a step. Basically, way down here, our max loss, we can lose $78.50, and we can make $21.50. Okay. So now let's do the same thing, except we're going to do the credit spread that's above it. Okay, so that's going to be our bear call spread. I believe we said 90, 91. Yep. Okay. So we'll do 90, 91. Okay, and it's just a stair step in the opposite direction. So over here, we can lose 63. You lose 63, and we can make 37. Okay. So if we look at these two together, I can make 21, I could lose 78 and a half. I could make 37, I could lose 63. So if I piece these two together, if I do both of these trades, I get an iron condor. And what will happen is my max profit will go from whatever I collected here plus whatever I collected here. So it becomes 58 and a half. 58 and a half. My max loss, though, it doesn't get added up. It's not 63 plus 78 and a half, because either I'm going to end up here above 90 or 91, or I'm going to end up down here below 84. Basically, these two parts of the graph, they don't overlap. They're separate. Only the stuff in the middle overlaps. So the stuff in the middle gets added together and the stuff on the side just stays the same. So that means my max loss is whatever is the greater of these two, because I can only end up in one place or the other. I can't end up in both places. So that means my max loss is 78 and a half. Okay. Oh, you're welcome, TP. You're very welcome. So let's see what it looks like, see if I'm right. So if we go to option strat and now do the iron condor, then we were at 90, 91, and then 87, 86, is that right? Or 86, 85, 86, 85, okay. Okay, so you see that the two in the middle, they got added together and became this huge hump. And then the ones on the side, they become the same, or they basically stay the same. And so my max credit now is 58.50, but I said that it would stay the same at 78.5, and look, I was wrong. Okay, it's actually less. And why is it less? It's because what happened was, what I didn't account for was that this right here, and you add it to this, it actually does overlap. It stretches all the way out. So this gain right here is 21.50. If I add that 21.50 to the 63 right here, what is that? Is that not 41.50? And then if I do the same thing over here, if this is 78 and a half, and I add 37 to it, okay, 78.5 minus 37, is it not also 41 and a half? Okay, so yeah, so these two gains do carry over and they bump these two up, and so they become the same thing, and so now my max loss is 41 and a half. Another way of thinking about that is I had a $1 strike difference on both sides. And since I'm collecting 58 and a half, well, the max distance in between any of these strikes is only $1. So that therefore my loss has to be 1 minus 58 and a half, which is 41 and a half. So I explained it to you two different ways why this gets bumped up to 41 and a half. Okay. Now, if we look at this and we go, well, this one has a 72% chance of profit. And this one only had a 54% chance of profit. Let's change this. I want to change this so it also has a 72% chance of profit, because it'll be easier to illustrate my point if I do that. Okay, so let's just change this until we get roughly 72. So that's 74. That's 70. Okay, so we perfectly span. Okay, so let's just say let's just use this as the example then. And in general, if we chose the price, the current price, to be exactly in the middle of these two strikes, then that's exactly what would happen, right? The probability of you going up or down, if we believe in randomness, is equal. Okay, so it closed at 89.70. So if I went 5 points above that and 5 points below that, then if we believe in randomness, then the chances of it going up and hitting that $5 versus going down and hitting $5, those are the same. Okay, and the probabilities would end up the same. But we didn't do that. We skewed it, right? We skewed it because we didn't think it would go above that EMA 20. So the point is that a lot of people, they will take a look at this and say, if I had this situation, if both of them had a 72% chance of profit, a lot of them go, wow, I have a 72% chance here, I have a 72% chance here, I have a 72% chance of winning. And by doing the Iron Condor, I just doubled the amount of credit that I could get. Why would I not want to do this trade? Because my risk is now less, my reward to risk ratio is now much, much better. Over here, it was 21 versus 78. That's like a 3.5 to 1, or one versus 3.5 reward risk ratio. And then this one was a same thing, about a 3 to 1, or 1 to 3. And so when I add them together, let's do, what are these? 93, 94. When I'm add them together, now it is a 1 to 1 reward risk ratio. Why wouldn't I do this Iron Condor? And the answer is because you don't have a 72% chance anymore. Okay. So if I look at this, if I have a 72% chance of winning, that means I have a 28% chance of ending up down here in this red zone. Okay. And if I have a 72, it says 70, well, okay, so if I have a 70% chance of winning on this one, that means I have a 30% chance of ending up in this red zone. I have a 100% chance of it landing in one of these three zones. Okay, either it's going to go from 0 to 86, 86 to 93, or 93 to infinity. Okay, there's only three possibilities. So that means the probability of me ending up in this green zone is 100% minus the probability of this red zone minus the probability of this red zone. So that is 100% minus 28 minus 30. That means my probability of profit, my chance of profit, should be 48%. So I took a 70 to 72% chance probability if I only did one side, and now my probability is only 48%. So yes, I collected a lot more credit and I reduced the amount of risk, and I have a better reward risk ratio, 1-to-1 reward risk ratio, but it came at the cost of my probability of winning. Okay, and so to show you that over here, chance of profit, 45%. Okay, not perfect, because you're right, we couldn't get everything lined up exactly right. So, but basically, that's, do you guys understand that? It's a very, very important point. I know a lot of people who love Iron Condors because they can collect, quote unquote, collect credit on both sides. Yes, you can, but you are also having your probability of profit. Not exactly having, but pretty close to it. Okay. So you can't have it both ways. In the market, you are paid for risk. So if you're getting paid more, that's because you're risking more. Period. End of story. Whether or not you recognize that risk is up to you. But you might feel strong in your technical analysis that it's going to chop between these two, or that it's not going to go above this. I guess we should change this to 93, 94. Okay, so you have to feel very strongly that's going to stay in here, because if it breaks below, like if I look at this through a different lens and go, oh my God, this is a downtrend, and actually the chances of a breaking below are higher than just 50%, then I don't want to do this Iron Condor. I won't want to do this side of the Iron Condor, right? Okay. Work getting in my way. Gotta go. Okay. Have a great day. Okay. Good luck at work. Kirk, TRC Capital mini tender offer. I don't know what TRC Capital is. Is that mini tender offer for what? What are they offering? So in any case, that's the Iron Condor. I get paid on both sides, but I have risk on both sides now. And so the extra payment came at a lot of added risk. So what am I trading? Pietz Chit, we're doing an education portion right now. I'm not trading any. We may get a trade idea out of this, but I'm not currently trading anything. I'll take a look. I might do an example trade on target. So, or no, iron was too gappy, but either target or CoreWeave or AXP, we might get a trade idea out of one of these. Okay. So that's the Iron Condor. Okay. You greatly increased your risk. You got paid for it, but you greatly increased your risk. And we just want to be aware of that. Now, something that I always tell people when we talk about debit or credit or spreads, whether they're Iron Condors or verticals or some other spread, is that if things are priced well in the markets, which generally the market makers do a pretty good job of pricing it very well, then whatever spread that you're trading, what you will find is that if you do the expectancy calculation, you will either break even or lose money. And if that wasn't true, then the market maker wouldn't sell it to you at that price, or wouldn't give it to you at that price, buy, sell, whatever, doesn't matter. Because the market maker's in the market to make money. Okay, so let me show you what I mean by that. This says it has a 45% chance of profit. Okay, so 45% chance of profit, 45% chance of winning, that means a 55% chance of losing. If I win, I get $48. If I lose $52. Okay, so that times that, and these two multiplied, and if I subtract these two, what I can expect is losing $7 on this trade. That means if I had 100 of the exact same setup on this trade, and I could trade it 100 times over and over again, I can expect to lose $7 per trade. I would end up losing $700. That's the way the market maker prices things. Even if I just did one side of this, okay, if I did where's my, okay, yeah, either side, doesn't matter, I'll do on both. Okay. So over here, I have a 72% chance of profit. When I win, I make 21.5. When I lose 78.5. Negative $6 per trade. If I do 100 times, I can expect to have lost $650. Okay, let's do it on this trade over here. I 70% chance of profit. Oops. When I win, I can expect $26.50. If I lose $73.50. Okay, I lose $3.50 per trade. So if I do it 100 times, on average, okay? So if I do it 100 times, I can expect to have lost $350. Okay? So if we do expectancy calculations, we will always come up with a negative expectancy. On very rare occasions, we'll see a break even. And on extremely, 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 extremely rare occasions, you will actually see a tiny, small positive expectancy, like 10 cents, 15 cents, okay, which not really worthwhile, but in any case, if you find one of those and you have a good reason to go into it, that's lucrative. That's a really good trade. but you have to have the fundamental reasons behind it. Now, remember what I told you guys, and I've said this concept to you guys before in the past. Every financial equation makes a baseline assumption that markets are random. And if you go into the history of how options pricing was come up with and many other financial instruments, how they were come up with, it always started with this idea that markets are random. Okay. So if it was true that markets are random, then the market maker priced everything so that they would make money. That's what you would do if you were a business, right? You price everything so that you can make money and you can make profit. You're not in the business of giving away money. So when we do these, if they priced everything appropriately, they make everything in their favor so that you would lose money. You can positively expect to lose money if you do the trades over and over and over and over again, assuming they were right about it being random. Okay, so I've said it many times over the last few weeks. One of the main ways we get paid in the markets is finding areas of the market that is not behaving randomly, because everything is priced as if it is behaving randomly. One of the best and strongest ways for you to put that in your favor, meaning that one of the best ways to find a non-randomness in a sea of randomness is the trend. Okay. Okay. So if we are moving clearly in one direction, that's not randomness. We can say, okay, we sort of randomly arrived there, sort of, because we kept going back and forth, but not really. I mean, we really moved over here, and then we went sideways, and then now we're really starting to move again. This movement in target was not random at all. Okay, if I would looked at, was it CoreWeave? That was another one that you guys asked me. Okay, this movement right here was not random. Maybe intraday we saw periods of randomness, but this was not random. There's no one, you cannot, a 3-year-old could tell you that this wasn't random. This is almost a straight line. That was not random movement. Okay, random movement would be, I don't know. Okay, this is random movement. And even then, if I change my time frame, suddenly it's not so random. If I change my time frame, okay, it becomes a lot less random looking. So the underlying assumption that markets are random is bad if you can find the right time frame, if you can find the right pocket. So target in the last 1 to 2 months has not been moving randomly. You could say maybe it was moving randomly over here, but it wasn't moving randomly over here. It wasn't moving randomly over the last few weeks. And yeah, that's all I'll go. Okay. So here it's not moving randomly. So if I go into that iron condor or a credit spread and it's pricing in randomness, but something is clearly not random, that's my edge. That's how I can get paid. Because the market maker is pricing this as if it's just moving randomly. There's an equal chance of it going up and going down. And what we're saying is, no, based on our studies, when it reaches the EMA 20, after it's been downtrending for several weeks, that is not an equal chance. It's not a 50-50 chance that is going to go up or go down. And in fact, it might be a 60-40 or a 65-40 or a 70-40. I don't know. I haven't run that study, specific study. Okay. So if I was doing my job super precisely, then I would run a study specifically on target and say, hey, after a downtrend, a pullback to the EMA 20, what percent of the time does it go up versus go down? And then I would know the exact number. But I do know the general rule in all S&P 500 stocks and anything that is highly correlated to S&P 500 stocks. Okay, so we have to be careful though. I'm not talking about penny stocks. I'm not talking about small cap stocks. I'm not talking about your random miracle pharmaceutical drug stock. I'm not talking about your IPO. I'm talking about S&P 500 stocks and anything that is highly correlated to the S&P 500 stocks. When we come up and we touch an EMA 20 after a downtrend, then we have a higher probability of it going back down than we do up. Do I know the exact number? No, because I haven't run it on every single stock. I could run it on every single stock, but I haven't. But I don't need to, because I know that if I go into this spread right here, which was the down spread, right? That was this one, the one that benefits of when it goes down. I know that it's not break even. I'd be a lot, if this was zero, or expectancy was zero or very small, like 0.5, then I'm golden. I don't care, because even if it's 51%, then I'm good because the expectancy is in my favor. At minus 3.5, that's still not terrible, right? That's still not, that's like 3% off of that $100. That was 3%, 3.5%. So it doesn't take a large percentage edge for me to break beyond that break-even point. For example, if it was 60-40, or sorry, 60-40 to the downside and 40 to the upside, then that would be good enough to overcome a randomness break-even of $3.50. It might not be good enough for like $15 or $10, but it's definitely good enough for 3.5. Okay, so I don't have to necessarily do the exact calculation, although if I'm following my own rules, which is that everything has to be known and calculated, then yes, I would do that. And in fact, in all of my trading services, I do that. So I don't just eyeball everything. I do exact, precise calculations on all of my services. But for educational purposes, it would take forever for me to run through all of that and actually do all of that with you guys. And so I know that for this spread, it can be overcome by this advantage. If it was the other spread where it was the other direction and it was $750 or $7.50, then I would be a little bit more wary. I'd be like, okay, let me make sure that things are in our edge, because the expectancy was it's skewed. I'm going to lose 7.5% on average. So, which is large. So I do need a larger percentage. So if let me put it this way. If I do 50% and 50%, okay, and then I make 100% when I win, but I lose 107.5% when I lose, what is that expectancy? Okay, so that means an actual, sorry, I need to do that differently. I need to do it. If this was, so this is 70-30, and the win rate that I need in order to overcome this, if these are my stats, then basically I need to change this. I need to goal seek this to 0. Where is it? Oh, there we go. So I need to change D3 to 0 by changing this. D3 to 0 by changing. Do these not have formulas? Oh. Okay. Goal seek this to 0 by changing this. Okay, so I have to make up for that 4% right there. Okay, so that means for the $3.50, I need a 54% chance of winning for break even. So if I have 60% chance, then I know I can consistently make money. But when this was 70, well, let's put up the stats over here. This one. Okay, so when this was 72% and 21.5, and that, or 650. I guess the Iron Condor was the bad one, was the really bad one. But in any case, well, I'll just use this as the example. And then if I can goal seek this to 0, you see that? 79, so it changed 9% or 7%. So I need a 57%. And so if my edge is 60%, that, yes, that is more. Maybe that's good enough for me to make decent money, but maybe that return is too small for it to be worth my time, effort, and energy. And so for sure, when we had that 7.5 with the Iron Condor, then the 60% probably just isn't going to cut it anymore. Even if it was slightly positive, do I really want to make 100 trades just to make $2, right? So it's not worth my time, effort, and energy anymore. So we want to be careful, and we want to know or be aware of that. Okay, so everything is priced as if it's random. I need an edge, and I need to recognize non-randomness inside the markets in order to give me that edge, and that edge needs to be strong enough to overcome the pricing of the market makers that they put into the options. Okay, so that we're always fighting with the market makers. They think that it's random, or they're pricing everything as if it's random. We believe that we know that it's actually not random right now. And based on their pricing is the edge that we get by knowing that it's actually not random right now. Is that enough to consistently overcome the market maker on over and over again, so that over a large number of trades, I end up collecting a lot of profit? And then that profit was big enough to make it worth my time, effort, and energy to make all those trades. Okay? So that's the basic concept in trading. Okay. All right, let's see. 1.5 million shares at 89. I'm not sure what you're talking about, Kirk, for target negative. 1.5 million shares at 89. I'm not sure what you're talking about. If you have time, can I look at UEC? UEC is looking great. I entered that into my portfolio today, actually, which is why these lines are here. Okay, so now I am positive. I put on a debit spread on 13.5, 13. I put it on at 13.25. You can see that it closed above the break-even point, and it's looking just great. UEC looks great. So for those of you who are looking for a trade idea, here's a trade idea. All right, one that I actually executed on several of my accounts. Okay, so UEC, beautiful positive trend. Roy G. Biv, okay, separation, increasing separation. Pull back to the EMA 8, although we closed right at the EMA 8, unfortunately, not above it, but still not too bad. Okay, and this is if we wanted to tie together another principle that I talk about all the time, that is a long-term trend, and now instead of using the EMA 8 as the short-term trend, I'm going to use price itself and say, well, when price reverts back to the same direction as the longer term trend, which it barely did today, okay, then that is a good entry point. And so there you go. That's the entire trade idea. And then the timing, of course, was today. Tomorrow, if you could get in near the same price, then timing is taken care of as well. Execution, I told you the exact trade I did. I did a 13 and a half call debit spread. I paid 13.25 for it. And this is my experience. Here's my max loss zone. Here's my max gain zone. I'm expecting it to pop up above. And so I'm just going to hold it to expiration. As long as it holds above my break-even point, then I'm just going to hold it to expiration. If it breaks below my max loss zone, then I'll close it and I'll take the loss. Okay, so now you have the entire trade. You have the trade idea, you have the timing, you have the execution, and you have the management. Cool. All right. You get this question a lot, but can you mentor me? Everyone needs a mentor. If you just watch these videos every day, I'm holding nothing back. And I think you can probably tell that I'm holding nothing back. So this is sort of like mentorship. I mean, you basically get to see my exact thought process and exactly what I'm doing, exactly why I do what I do. So go back. My highest recommendation is just keep showing up to the Post-Market Live and even review some past ones. There are some really key ones that we've done that could cover some really, really important concepts and powerful edges and thought processes that you don't find outside of institutions. So that would be my best recommendation. Yeah. Amazing Iron Condor explanation. Oh, you're welcome, Maria. Thank you. The mini offer for Target. Oh, you're saying that some institution or some capital offered Target or is trying to offload shares. Is that what you're saying? Oh, you're welcome, C. Fazio and Adam. UEC, those three lower high price rejection candles are not a concern. These? No, those are just very temporary. Okay, so let me see if I can find another example. Okay, well, let's take a look at what Gamma says, okay, on UEC. We're a couple minutes over, but it's okay. UEC. So, and also, one other detail that we should look at is net buying volume. This is net buying volume. And even though it rejected this level, and maybe you say this level and this level, then the net volume is positive. And so if I look at a volume profile, okay, you can see there's a lot of buying right here, where we are right now. And then if we look at Gamma, look at that huge Gamma pocket right there at 14, right there. And so we got 14 and 15 and 16. Okay, and then maybe when we get there, we might start seeing 17 come into play as well. So I'm not concerned about UEC at all. 14 should be super easy. 15 is, also should be relatively easy. 16 should be possible. So I don't know where that shows up on the chart, but we can mark it up. Okay, so let's do, I should choose a different color for Gamma pockets. What's a good color for Gamma pockets? What do you guys like? Blue, cyan, aqua, whatever that color is. Let's do 14. Okay, so that's today's high. So if it could hit that high today, it could hit it fairly easy. 15. Okay, 15 was that high right there. And then 16. Okay, which is great. So we have a lot of interest above us, and in my I don't care anyways. All I care is that whether or not it stays above 1325 and I break even, or even better, if it stays above 13 and a half, in which case I'll make full profit. And if you notice that the spread is only 50 cents apart, it's 13, 13 and a half, and I paid 25 cents for it, that means I could make 25 cents, so I can make 100%, as long as it stays above that 3.5. So no, I don't care that it rejected these levels. All I need it for is to float around up here, but I do believe it'll trade back up to 14 and 15, maybe even 16. Okay. Couldn't get filled at 53 cents today with UEC. Oh, depend which option, Tim. You're very welcome, Maggie. You're very welcome. Okay, I'm glad you guys are enjoying the sessions. All right, so that's gonna end it for today. Hopefully, you guys learned a whole bunch about iron condors and how to think about them, especially towards the end. We're talking about the risks and the compensation for the risk, and also how the market maker prices options and how we overcome that pricing. So if you enjoyed it, please give it a thumbs up. That'd be great. Otherwise, don't do anything at all. And I will see you guys tomorrow. All right. All right. Spread 55 cents on, I imagine a $1 spread then, right? If you're looking for 55 cents. So maybe 13, 14, you were looking for a 55. I'm live every weekday from 4:30 Eastern to 5:30 Eastern, and then like today, I might go a little bit overtime. And every once in a while, if I'm not feeling well, or I'm worn out, or if I'm traveling, then I'll miss the session as well. Okay. Roger was wondering who would buy Target. Well, I mean, to downside, right? Buy it to upside? No, yeah. No. Okay. All right, guys. Thank you very much, and have a wonderful rest of your night, and I'll see you guys later.